I totally agree with all your comments, Randy. I would add that there's, depending on who you talk to, $400 billion plus in dry powder within these private equity firms. And if you add the typical leverage that they would use, that would give you about $1 trillion of buying power. And if you think back, the peak year was '07. These firms typically have 5 years to invest this money, so we're 3 years close to it into it. There's going to be a lot of pressure to put that money to work because it's totally in their economic interest to do it. And I think that bodes well for sell side situations out there, be it public or private companies.
Um, Randy, you said it's hard to kill a GP. I agree. They're sort of like the cockroaches in the nuclear holocaust. They seem to survive everything, but I don't think it's impossible to kill a GP. And I think that the major sources of capital, the major pension funds, and institutional investors out there are figuring out that they've created a very, very inefficient model. They've created incentives that are completely skewed the wrong way. They're skewed towards management fees. Most of the folks that we know in the private equity world, sort of view their carry as the icing on the cake. And it used to be that the carried interest was what aligned a GP's interests with his investors' interests. So while it is very difficult to kill a GP, I think that institutions are wising up. And I'd make two comments. Number one, I think, and you've seen a couple of these already, but I think you're going to see what I would call sort of forced mergers in the private equity world. I think that a lot of the major institutional investors are saying there's just too much infrastructure out there. Why are there three firms doing the same thing with three administrative overheads? Why not take those three firms, put them together, get rid of a lot of the administrative overhead, potentially cut the fee burden a little bit, and let them go out and try to find deals. The other comment I would make is that notionally there is an awful lot of capital sitting on the sidelines, and the statistics are familiar to all of us. But I'm not sure that notional capital actually reflects real capital available to do deals. CalPERS, just to give you one example, Peasers is another, have called a lot of their GPs and said, look, we're not reneging on our fund commitments, but don't call capital from us. And if you do call capital from us, know it's the last capital you'll ever see from us. So while, again, notionally there's a lot of dry powder out there, I'm not sure that the actual dry powder available to do deals is quite as high. And I think that there's going to be an awful lot of dislocation over the next couple of years as all of those cross currents start to get shaken out.
Well, Jim, you just mentioned forced M&A with some of the private equity firms. Can you give us some insight into the M&A arena in general? What were some of the key numbers for 2009? What do you foresee for 2010? If the public offering and credit markets continue to remain tight throughout the coming year, it seems logical that this may be the best or only source of exit or liquidity available.
Well, if you'll let me, I'd rather not talk about 2009. I could talk about the fourth quarter of 2009 because the story throughout 2009 wasn't very positive. But I think as Randy and Tom would attest, we started to see some signs of light in the fourth quarter where dollar volume was up substantially. The number of strategic deals that were completed in the fourth quarter of 2009 was up north of 20% in terms of value over where it was in 2008, and the deterioration on the financial side basically came to a halt, and the number of financial deals was flat in the fourth quarter. Multiples have clearly contracted. They have to. On the financial side, the inability to leverage transactions at the rates or at the levels that we were leveraging them 18 months or 2 years ago just dictates that multiples have to come down for investors to be able to realize a return on that equity capital. So on the financial investor side of the world, multiples have come down significantly. The average multiple that people talk about today is something like 7.5%. In the middle market, which I would define as kind of the under $250 million market, the multiples are even lower. And in some sectors, multiples have come down precipitously. The restaurant sector would be a great example, where multiples are in the 5.5 range, and 2 years ago they were 8.5 or 9 times. There's been obviously a tremendous uptick in insolvency-related transactions. That's a business that we're all in, and that has, for many firms like ours, been frankly our savior over the last year or so. I think, just kind of more subjectively, there's the beginnings of a sense of seller capitulation out there, particularly in the sort of entrepreneurially driven, small to mid-sized company marketplace. A lot of these sellers have been sitting on the sidelines for 2 years, hoping that maybe the environment that they basically were unable to take advantage of, through the middle of 2007 will reemerge. I think that most of them have been to enough conferences like this and heard enough folks like us tell them it isn't going to happen, so that they're beginning to believe that the world has changed, at least semi-permanently. We'll never say permanently, because the minute we do, we'll be wrong. And then two other things have happened to those businesses. Number one, they've survived, or we wouldn't still be talking about them. And in surviving, they've kind of answered that fundamental question that you always have to answer in a sale transaction, which is, how does your business perform in a downturn? And number two, those entrepreneurs have gotten older. And the reasons why they would seek liquidity have probably become, the dependency of them has become more important. And then I think there's one more factor that's going to drive activity this year, and that is, I think, an assumption, and you guys at HA&W can speak about this more authoritatively than any of us, but the assumption has to be that capital gains rates are only going in one direction. So I think the cost of doing transactions is going up. The likelihood is that anything that gets done in 2010 gets grandfathered, and I'll bet dollars against donuts that Randy and Tom are using that in their discussions with clients, because we sure are. The only other comment I'd make on, because you, at least in the written question, you'd asked me about the international market, is that the international market's kind of driven by three factors. Obviously, it's driven by economic outlook, just as the domestic market is, but it's also driven by exchange rates. And, there was a time 2 years ago where we were running a half-off sale on any dollar-denominated asset versus the euro in particular. The dollar has rallied of late. But the third factor that's always very important in gauging sort of international appetites is the assumed future directions of exchange rates, so exchange outlook. And the reason for that is that if you buy something in a half-off sale, but the dollar continues to deteriorate, when you repatriate earnings, you're going to lose a lot of money. 2 years ago, I think the consensus among our international clients, and we do a lot of cross-border business, was that they were buying at historic values given the difference between the dollar and the euro in particular, and that over time the dollar was likely to rally. If you believe in purchasing parity, and you'd been to Europe 2 years ago, you would say the same thing, and therefore they were going to make money coming, and then they were going to make money going as they repatriated earnings into their home currency. I think that third piece of the equation has changed. I think that the outlook for the dollar long term is much cloudier than it has been, and I think that that's going to continue to be a dampening influence on cross-border transactions for North American companies, at least for the foreseeable future.
Yeah, we tend to segment the buying universe into strategic and financial buyers. And of course, last year, with the lack of credit, strategic buyers became much more important. Had the buying power, so to speak, with the cash on their balance sheets. I think this year, as the credit markets open up, that the financial buyers will come back in and be more aggressive. Randy mentioned some numbers about how much volume was down last year on the private equity side, and it's certainly true from what we saw. But this year, I think, as banks and other lenders will lend higher multiples of EBITDA, that the financial buyers can start to justify numbers again that will be competitive with the strategic buyers, and it should be a more vibrant market this year.